Hi, Assalamualaikum and good morning everyone. My name is Muhammad Amirul Azad and welcome to my channel. Have you guys ever heard about repurchase agreement? If not, let me show you a video. Today, I am joined by two experts in repurchase agreement, which is Mr. Azizat and Mr. Daniel. So, my question is, what is repurchase agreement?
Let me briefly explain about repurchase agreement. Repurchase agreement is one financial commonly used in financial market. It involves two parties. That one party they sell the government security to another party, and another party agree to buy them back at a higher price. The high price also known as a repo rate. Repurchase agreement also known as short-term funding and liquidity management. In practical terms, repurchase agreement is secure short-term loan and important to the bank to be stable in their liquidity management.
Today, I will tell you about what is the market participant in the repurchase agreement. First, we have the central bank. You can think of it as the lender of last resort. When other institutions run out of cash, the central bank steps in. It manages interest rates, controls money supply, and keeps the financial system steady. Next are the commercial banks. They provide loans, accept deposit, and manage saving accounts. In repos, banks also provide high-quality securities like government bonds as collateral. This reduces risk and help the market to run smoothly. Then, there are investment banks. They help big companies and government raise money. They borrow cash in the securities as collateral and buy them back later, keeping the market liquid and efficient. Finally, we have pension funds. These long-term investors collect contribution to pay for retirement. In the repo market, they provide short-term financing support, interesting rates, and help make the market stable. Okay, now let's ask Mr. Daniel Fahmi to explain how the purchase agreement actually works.
Okay, so I will tell you guys how does repurchase agreement work. Repurchase agreement, or as we know repos, works when there is a bank sells financial instrument to another bank with agreed price. Then the bank will buy it back on specified future dates. In Malaysia, we have Bank Negara Malaysia as the conductor and Malaysian government security as the collateral. So, for example, Bank A entered a 1-month repo and sells the securities to Bank B for the price of 108.74 million ringgit. Then, after 1 month, Bank A repurchased it back for the price of RM 109.07 ringgit from Bank B.
So, now let's go to our friend on the other side and explaining about the significant features that benefit to investor and issuer.
Repurchase agreements or repo offers many features to the investors. Firstly, repo is a secure investment term. This is because if the borrower fails to pay, the investor will be protected as it is backed up by the collateral. Secondly, repo is a flexible investment term. This is because the investor can choose either short or long term to pay. This can make them react positively to the interest rate change. Lastly, repo offers stable return for investor as it is fixed amounts at the beginning, so the investor can know how much they will pay at the end of the maturity date. Next, I will pass this to Adam.
Next, we move to benefit to issuer. The first benefit is low cost of borrowing. It's because it's secured by collateral. That means the lender risks are low, so the issuer will pay low interest rate rather than unsecured loan. The second one is immediate access to cash. The issuer get liquidity quickly without they need to sell their asset permanently. Last but not least, the last one is retention of economic interest. That's mean the repo price is fixed in advance. So when collateral price up in the repo term, the issuer will buy it back with the pre-agreed price.